So remember that quote I started with about this being complicated? Now you know why. And there will be a test, by the way, at the end. One thing I'll mention, and Roger alluded to this, one of the reasons for the complication is the difference in the tax treatment of health insurance premiums based on whether or not you get them from your employer or whether or not you get them as an individual. The employer tax deduction for health insurance premiums costs the federal government more money every year than the mortgage interest tax deduction for individuals. So if you want to know why that wasn't just expanded to individuals to simplify the whole process, comes down to, like everything else, it comes down to money. So next couple of slides, I'm really going to breeze through. This is kind of your notification that there are some things you need to be aware of. You all have the slides in front of you, so I won't go in detail. Basically, the first one, there's a notice, regardless of whether or not you offer coverage to your employees or not, that you have to send out every year. I think of this as just another water cooler notice. You have to have a poster up about minimum wage. You have to let your employees know about the presence of the marketplaces. And there are model letters to send out that differ based on whether or not you're currently offering coverage. SBC, Summary of Benefits and Coverage. Before the ACA, if you wanted to know exactly what was in your health insurance coverage, you would request from your insurer something called a summary plan description. Often that was over 100 pages of legal text saying what's included. One of the innovations of the ACA was to create these SBCs, which are a standard 8-page form which says what's included. And if you remember, we talked about the marketplaces allowing you to do side-by-side comparisons. Well, one way to think about that is what the marketplace does is it lines up these SBCs next to each other so you can actually compare on an apple-to-apples basis what's covered. COBRA, there is a new notification letter for COBRA, again letting people know about the marketplaces because COBRA coverage is not tax deductible. That's the individual paying the full amount. So often going to the exchange would now be a better option for people than to enrolling in COBRA coverage. So something else to be aware of. New hire waiting periods. If you do offer coverage, you're limited to how long you can ask them to wait before they can enroll. And that has to do with marketplace eligibility to kind of get everyone on the same calendar. W-2s. Large firms have for several years, and different definition of large firm here. Now we're talking about firms that issue 250 or more W-2s every year. Those folks have already had to include the cost of their health benefits on the W-2. This is not taxable income. Let me say this again. This is not taxable income, but much like your 401k number, it's there for informational purposes. The final rules have not yet been issued, so we don't know the timing for the rest of employers to have to include that, but that is coming as well. Cafeteria plans, that's how you offer things on a pre-tax basis. The rules for that have been simplified. Some very small firms have not gone through the process and have not taken advantage of that tax deduction. It's easier to do now. MLR rebates, a great issue on a national basis in terms of making sure insurers spend enough of the premium dollar on actual health care. Here in Maine, we are, what I would say, fortunate enough to say that all of our major insurers comply with the regulations, and so there have been no rebates, so we won't spend time on that. This is your eye test for the morning. Yeah. Again, this is one of the reasons you have it in front of you. We're not going to go into a lot of detail because of time. The issue here is how are premiums calculated for your workforce? And I have to talk about 3 different time periods. Pre-ACA, you would give your broker or your insurer a census of your employees and their ages, and they would come back to you with what is called a composite rate, a single per employee rate that is what you would charge, what they would charge you for each employee. The ACA wanted to introduce some more transparency to that process. So they said, let's go behind into the black box and say the insurer has to tell you what the rate is for each employee. The rates always differed based on age, and then they created the composite. Now they have to tell you what each employee's actual number was. You still had the ability to average those together and charge each employee the same thing, but you were seeing more numbers. And to be honest, it caused a lot of confusion and a lot of angst because some people didn't quite realize the difference in cost between their younger and older employees. In response to that angst, if you will, there are new regulations out allowing insurers to once again offer a type of composite premium. It's a little bit different, still includes some transparency features, but allows you the certainty of knowing that here's a single rate that will be available for your new employees as well as your existing ones as the year proceeds. Those will be available, but are not mandated, but they would be available beginning in 2015. As of now, the insurers are still working on their IT systems. They've said they're not doing this at the present time. One of my side roles is I sit on the state legislature's Exchange Advisory Committee. We're taking a look at this. I personally would like to encourage the insurers in the room to think about maybe offering this moving forward, because again, the benefit for you as employers is it gives you that certainty. In the current scheme, if your census changes during the year, your rates are going to change. You're not just going to have a new average rate, you're going to have a new rate based on the individual who leaves, or the rate will change based on the individual who arrives. So that's the point of all this. Subsidies. Roger alluded to these. I won't go into the details of how the individual subsidies are calculated, but here's the key that I want you to walk away from. And that key is, if I can find it on my own chart, this column here. That's the percent of income that an individual is asked to contribute to their individual premium. That varies based on where they are with respect to the federal poverty level. The less you make, the less percentage you're expected to contribute as an individual. Stressing as an individual. This is not the case for employees. For employer coverage, the only number is the last number, the 9.5%. That's the gauge of affordability, and that applies to everyone. So this is to emphasize Roger's point that some folks might get a better deal on the individual marketplace. But it is a complex question. It depends on their income and their family income. So just know that there's a lot going on. Kevin's question alluded to the cost-sharing subsidies. Those earning less than 250% of the FPL, the federal poverty level, have access to another level of help, which is the cost-sharing, your co-pays, your deductibles. Those are adjusted for those folks. And finally, a level of financial help that is available to everybody, insured, self-funded, on marketplace, off marketplace, and that's the out-of-pocket maximum. This is something that I think is one of the most important protections. Before the ACA, it was estimated that up to 3/4 of personal bankruptcies had some sort of medical cost component, that it was those costs that drove you to bankruptcy. What this says is if you are covered, you will not be asked to spend more than $6,350 a year on your care as long as you go in network. But after you've spent that much on your copays and deductibles, full coverage kicks in. And so those large risks, those million-dollar debts are hopefully a thing of the past. I need to wrap up. Roger alluded to this. We refer to this in the business as the family glitch. This is the use of the word family income versus individual income with respect to affordability. So if you make it affordable for the individual, the family is excluded from going on the marketplace and getting subsidies. And if there's more questions on this, we can go into that during the Q&A. We talked about that. Contributing to employee coverage on the individual marketplace. Roger talked about this. You can't do it on a pre-tax basis. So what do? And I'm going to steal 2 more minutes to do a wrap-up because this is really why I think many of you came here today. What do you do that's best for your employees and best for your own business? Because you need to run a viable business. If you have fewer than 50 full-time equivalent employees, you have options. In fact, this year for 2015, if you have less than 100, you have these same options. You can offer to your employees and dependents, and we should really also talk about spouses as a separate category. You can offer to everyone. You can offer to a subset. You can offer to just your employees if you are not required to offer coverage. If you are in the category required to offer coverage, you have to offer to dependents but not spouses, just to add one more wrinkle. And finally, if you're not in the coverage, so this year less than 100, next year less than 50, you can choose not to offer coverage, thinking your employees may be better off on the individual marketplace. We've alluded to some of the factors that go into that decision. This is kind of a summary for you to take away and meditate on as you go. So I'm going to stop there. I think we're going to invite Roger to come back up and join me. The last 2 pages here are just some more links and resources. So with that, I guess first, any technical questions on what I covered, and then any general questions for either Roger or myself. Ed.
Yeah, I think Kevin's question was really a very powerful one. And I think the question, and it may be applicable to a lot of people in this audience, you had a chart which showed, is it possible for you to show the chart that had that showed what 250 looks like? What 250% actually looks like for a family of 4?
So for a family of 4, 250% of the federal poverty level.
So for a person making
60,000.
Yeah. So if the combined income is, let's say for the sake of the discussion, is $48,000, $52,000 or something like that, you're in there for that additional subsidy.
Right.
Is that correct?
Right. That's correct.
And so if the family, and that's true up until $59,000.
Yep.
Right? The combined family income. So that's an important, so really when you move over to that subsidy, the subsidy would actually be greater
than the premium alone.
Right.
That's right.
Absolutely.
That's important to keep in mind.
Absolutely. So when you think about pre-tax versus post-tax dollars and try to do some sort of calculation to see how your employees might be better off, that cost-sharing subsidy is something you're going to have to try to account for as well. It's not just the premium subsidy. In the back, yes?
So earlier, I think you or somebody else suggested one idea would be to provide no spousal benefit or family coverage, then the individual could go on the market. And I'm looking at how does that fit into the family glitch?
So,
Go ahead.
Yep, so let me go a step back and go over what all the different pieces are, because there are a lot of moving parts there. Go to that second page. There's a reason I included that quote about complicated. If you are not required to offer coverage, so you're under 100 this year or under 50 next year, 2016, then you have all the options open to you. That's from the employer side. From the individual side, the way your subsidy eligibility is determined is based on both offer and affordability. So those 2 different pieces. Okay? So for spouses, and no one is ever required to offer coverage to spouses. If the spouse is not offered coverage, then they would be eligible for a subsidy on the individual market.
Dependent upon household income.
Yes.
In other words, you're as an employee, if my spouse goes to the exchange because, well, in my case, she wasn't offered coverage, they're going to look at the household income, not just her income. That's important.
Right. Right. So, have we succeeded in adding to the confusion?
I want to just bring up one point briefly. Is that okay, Wendy?
Sure.
One option we didn't talk about. Remember I mentioned that, and you brought up a good point, that you can't combine a pre-tax feature with sending your employees out and getting individual policies. But what about this? There are now some companies in Maine that are starting to offer private exchanges. All right, these are not the exchange we have up here. These are exchanges where a provider, it could be an agency, it could be somebody else, has signed on with a number of different insurers to offer coverage basically on a web base that they've created. Now, I as an employer set up a defined contribution plan, like a 401k plan. I say, I'm gonna give every employee $4,500 this year. You go to that exchange and you buy what you want. You can buy down or you can buy up. Up to you. And you can buy from any one of 3 carriers. You can buy different level policies. Do you think that money I'm giving my employees pre-tax? It is. And I'll tell you why. It's because even though I'm giving each employee individual choice, the products that they're going and buying are group insurance. They're not individual policies. So it's kind of a marrying of the individual concept with group insurance tax benefits. It's really started at the high end of the market. You know, Sears, about 5 or 6 large employers nationally are already doing this. They're setting up defined contribution plans for a number of reasons. It allows them to budget exactly what their health insurance is going to cost them that year. They set the reimbursement rate, not the insurer. So I just wanted to bring that up.
Yeah, the caution is the confusion that sometimes arises because they use the same term, exchange or marketplace, as the federal one. There are no subsidies available on those private exchanges.
That's right.
So that has the same issues for what your employee gets as it does as if you would offer coverage directly. The other thing, one way to think about this idea of a defined contribution health plan reflects what happened to pensions 20, 25 years ago with the really popularization of the 401ks. Before 401ks, an employer would often offer a pension that was a defined benefit, not a defined contribution. You work a certain number of years, you get X dollars every year. That is rarely the case today. Now you contribute to an account, the employer contributes to an account, and the money in that account is whatever it is. Your pension is whatever is left in that account, not a guaranteed amount. The issue we've seen with pensions is a concern moving forward with doing the same thing to healthcare, is that the contributions don't end up keeping up with the cost of the coverage. And so as time moves on, an employee would get less of their premium covered by the employer and have to pay more out of pocket. So there are some great things, both for employers and employees with these private exchanges, but there are some cautionary notes as well.
Yes, sir.
Roger, for the purpose of taxes or insurance, what is income? Earned income or all income for household?
Great question. It is household income. And what it is in essence is the bottom of page 1 of your 1040, your adjusted gross income, less, I'm not sure, less something.
Yeah.
I think it might be less tax exempt, but I'm just not sure. It's an adjustment to it's basically your adjusted gross income, but I do think you might reduce it by tax exempt.
So it's earned income and any other income?
Yes.
Okay,
Yes.
that's an important point.
Yep, there's a, and I don't remember the line number, but there's a line on the 1040, and the title is MAGI, Modified Adjusted Gross Income.
Right. I think
Can you get the answer and then
Yeah.
we'll make sure that.
Yeah, I think it's AGI less tax exempt and a couple other things you never see, but I think that's the big adjustment.
So it would affect unearned income as well?
Yes.
So any stocks, any interest?
Yes.
That's included,
That I'm sure of.
yes.
One more question, this one's easier for you. Subsidies ever need to be repaid?
Only have to be repaid if you receive an excess subsidy. Because what happens is when I go into the exchange in November, they're going to base my subsidy for 2015 on past data.
My thought was a starting employee, relatively low income at the time, eligible for subsidies, and as their income level grows, their estate bills, is there ever a time when the government says, we once contributed to you,
Oh,
now
no.
you need to repay?
At the current time, no. That's a great question, but not, who knows? But not, well, just like, for instance, retirement plans. I just read another article that the government's really worried about high balance retirement plans. And there was a time about 10 years ago where they taxed excess accumulations in retirement plans. Right now, they don't. Maybe they will again. But right now, the subsidies have it's a one-time event unless it needs adjustment because of excess received.
Let me elaborate on that because that raises two minor.
Quick.
Okay, there's so much to talk about. It's important that as your income changes during the year, individuals go in and note that in the marketplace so your subsidy is adjusted. Because while the government will not take back subsidy that you're eligible for, if they end up paying you too much, then when your taxes are filed, as we've said, it will take that back. There are limits on how much it can take back unless you cross that magic 400% threshold. If you end up going above 400% of FPL, then you can be asked to pay back the entire subsidy that was advanced to you that year.